Alright, guys, so this is a good one. I never thought it would happen, but it did happen. Now, things have taken a really desperate turn, and we have to scramble all the way back to Argentina. Now, the panic of losing a Malay government and more Chinese influence in the country is warping the brain of Scott Bessent. And the last time we talked about the bailout, Bessent was thinking of giving Malay three things: a currency swap line, direct purchases of the Argentine peso, and buying up Argentine bonds. I don't think this will go down well with ordinary Americans who they need a bailout, especially when the government shutdown is threatening not to pay workers. But protecting the reserve currency and US influence in Argentina seems to take priority. Now, this is not a charity drive, guys. There are definitely terms and conditions hidden in the shadows. Now, according to Besson, the first is to ensure they will generate significant dollar denominated exports and foreign exchange reserves in dollars as well. In other words, price your exports in dollars and store dollars as your reserves. Besant wants Malay to continue dollarizing the entire economy, which actually makes Argentina more vulnerable to US fiscal and monetary policy. Now, the next part is very surprising. Besant purchased Argentine pesos directly. Now, this is nothing short of a direct currency intervention. The US Treasury went in to start the bailout by selling dollars to buy up Argentina's local currency. In addition, the US will issue a $20 billion swap line to Malay's central bank, and more exceptional measures will be taken if things get nasty enough. So this might not be the end. Besant could continue this rescue and prop up the Argentine bond market. But let's get a little serious here. Will $20 billion be enough, or is it money just going into a black hole? Now, from now until October 26, which are the elections, Milei needs to desperately contain Argentine inflation. That one metric alone is enough to win or lose elections in ultimately any country. Now, the peso keeps getting devalued. In just 3 months, we have gone from 1200 to almost 1500 versus the dollar. It's a 20% devaluation, which means Argentine imports are getting more and more expensive. So, to combat this, the central bank has to keep selling dollars to save the peso. There are even reports of less than $1 billion left in the vaults. That's probably why Scott Bessent had to rescue Malay's economy. However, there's another crisis brewing. The Argentine bond market is not in the clear, and whatever aid Bessent is giving might spill over to debt buying. This bailout clearly isn't over yet. Now, Argentina has two main sources of dollars. The first is government revenue by taxing exports, and the second is borrowing money from global investors by issuing their own dollar bonds. Well, that market is still in panic mode. Argentine dollar bonds are still yielding way above 13% today, meaning future bonds sold by Malay's government will have to give a higher return to match expectations now. And if dollar liquidity dries up, we could see these bonds recollapse once again. Not only will the peso crash, investors will be even more hesitant to lend Malay their dollars. Now, there's a fair chance of this happening, and if it does, the US will be on a hook to bail out Malay again and again and again. So, this is the trap Besant has committed himself to. It's really bizarre if you think about it. We could start to see traders testing US resolve. Speculators could start shorting the peso to test if Scott Bessent will crack. It's not because the US Treasury has no money, no dollars, but political will is very fragile back home. Now, Senator Elizabeth Warren is asking hedge funds if they had anything to do with the bailout for Argentina. And this is the part of the letter she wrote to them. Clearly, she's very suspicious to say the least. $20 billion may not be enough to staunch Argentina's economic decline on its own, but it could buy time for hedge fund investors to exit their positions without suffering massive losses, which tells us that Bessent's hands are tied. Yes, $20 billion on the onset sounds like shock and awe, sounds like a lot of money, but it's clearly not. The Argentine economy is far from stable and they are still exporting to China. Now, immediately after the tax holiday on agricultural exports, China started buying a ton of Argentine soybeans. Now, there are reports that Beijing bought over 15 cargoes. Instead of US supply, China's going straight for Argentine exports instead. And of course, US farmers, they're not going to be happy about this. They're really pushing Trump all the way to the ropes. He is considering a massive $10 billion bailout to US farmers using taxpayer money. Now, Bessent is getting an enormous amount of pushback, and it seems a ton of people they are not buying it. He's also throwing the good old get China out of Argentina card now.
And he is committed to getting China out of Argentina. They're all over the place in Latin America. And when people say to me, how is this not America first? I'll tell you why it's not. Do you want to be shooting at more gunboats like in Venezuela? We do not want a failed state.
So this isn't a bailout?
Sorry, it's not a bailout at all. There's no money being transferred. The ESF has never lost money. It's not going to lose money here. I was in the investment business, mostly currencies, for 40 years. You're supposed to buy low, sell high, and the Argentine peso is undervalued.
So Bessent's bailout probably doesn't have legs. If the crisis drags on in the country, chances are the US will have to end the support. But what does have legs is China's move to de-dollarize the world. The global currency battle is getting nastier, and China is flexing their supply chain to push away dollar trade. Now, take the Chinese supply of rare earths for example. Beijing controls 60% of mined rare earth metals used in magnets. In refined metals, the control is almost at 100%. And this is the leverage when you control the supply chain, which means China can easily go around the world and demand their exports be paid for in the RMB. No settlements using the dollar, but the local Chinese currency. And just like how the US settles their trade in dollars, China is now doing the same. When you get countries to use your currency to settle trade, it creates a very nice feedback loop. If you're the exporter and the RMB you get from China will eventually be recycled back to the Chinese economy. In effect, China is making it more likely their own industries gets the demand they want. A week ago, China banned iron ore cargoes from the mining giant BHP in Australia. All new cargo purchases were effectively halted, but some supplies priced in the Chinese yuan were allowed to land in China. Now, sure, it might be a question of price, but chances are the settlement currency also plays a big part in the equation. Iron ore is the base input when it comes to steel production. We already know China is the world's factory. They produce everything from solar panels and EVs all the way to heavy machinery and smartphones. Domestic industry alone in that country is so massive that steel demand there dwarfs everything else. Every country that mines iron ore cannot neglect China as a major customer. China produces over a billion tons of steel annually, and that is the number in 2024. And with the US trade war today, we can expect this amount to go higher. Countries will need affordable Chinese steel to climb over Trump's tariffs. Over 50% of total steel production is controlled by one single country. And this gives Beijing a very big amount of leverage in iron ore imports. If you want to sell to our markets, we will need you to accept our currency. Now, this might sound unthinkable, but is it really? A currency is simply a medium of exchange. As the US retreats and China goes out and globalizes, this ebb and flow is natural. Now, if Trump wants to slow down China's currency encroachment, he simply has to U-turn the entire trade war. But as we all know, that is impossible, especially at this point. China's currency will continue to propagate. And without much of a surprise, BHP compromised and agreed to settle in the RMB for their cargoes. So we can expect more miners like Rio Tinto and Vale to switch to the RMB as well. The bigger Chinese industries grow, the more leverage Beijing has. The more EVs China pushes out, the more iron ore to make steel they will need. And this won't stop at iron ore or commodities. As China builds up their entire chip industry, we can expect the future of semiconductors, especially in Asia, to be priced in the RMB as well. But let's talk about our final topic today, which is Japan's re-collapse of the yen. Now, this looks really bad because if a currency is crashing harder than the dollar, it means something is seriously wrong. In the past 6 months, the yen is down by almost 6% despite the dollar falling. In fact, we are heading towards the sharpest weekly fall this year. Now, Japan, just like Europe, is moving towards a future of fiscal expansion. Doesn't matter what the national debt is, doesn't matter the consequences to the currency, This is the road they are on. And everything ties down to the election of the new Japanese Prime Minister. Now, Shiba is out, and we now have Takaichi, I think, at the helm. And she's a great example of a fiscal daft. Now, truth be told, Japan doesn't have much choice in this trade war. US tariffs are squeezing them, while Chinese exports are just too competitive. And the only option left is a much looser fiscal and monetary policy. As the yen collapses, we are seeing risk assets in Japan rise, but bond yields have also risen as well. Now, this is bad because it drives the national debt to catastrophic levels. Now, during her run, Takaichi said lifting interest rates would be stupid. In other words, Japan is drifting closer towards massive currency debasement, and that is their safety parachute to survive the trade war. Now, I have a lot of reservations about this one. Firstly, the cost of living in Japan would most definitely increase. Great for tourists, but horrible for the locals. The standard of living is going to drop. Now, secondly, is the national debt. A weaker yen will rattle investors. Even without the rate hike, bond yields could keep rising because now investors they want a greater compensation. And before you think we are dismissing this, she defended the merits of a weak yen on TV, and that tells us a lot. She's telegraphing the punch. As a rule of thumb, I would say there are both merits and demerits to a weak yen. Export focused companies, this is a buffer given the concerns over the Trump tariffs. Now, I'll be polite here. Unless the yen suddenly crashes by another 10 or 20%, I don't think you'll do much against Trump's tariffs. In fact, if that happens, the cost of production, especially energy imports, is going to shoot to the moon. There's a lot of black swans circling this mess. For example, we have the yen carry trade at risk of imploding once again. However, a bigger risk is who is left holding the bag if the yen keeps collapsing. Now, these are the biggest holders of Japanese government bonds, and yes, the Bank of Japan itself owns 51% of it. Foreigners own less than 6% of total outstanding debt. And if the yen continues to crash while yields continue flying up, foreign demand could disappear. Even banks and their own life issuers might buy less. Then the lender of last resort would be the Bank of Japan. And when a central bank steps in to buy government bonds, they're essentially monetizing the debt. That's money printing. So now we have a flywheel of further currency debasement happening. There are really no good options left for Japan. If they hike rates, their exports become less competitive. But if they devalue the yen, production costs go up as well. The only out right now is a miracle for the trade war to end. But as always, let me know what you think. Will Bessent's rescue to Argentina work? And can Japan escape their sticky situation? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.